the Aligned Economic Index, and the State-Switching Model. Ilias Aarab, European Systemic Risk Board, European Central Bank. University of Antwerp. June 2019. A growing body of empirical evidence suggests that stock return predictability is not constant over time, but instead varies across economic states, with much of the forecasting power concentrated during recessions. In this paper, I examine U.S. stock return predictability across different economic regimes and find strong, persistent evidence of time-varying expected returns, both in expansions and contractions. I make two key contributions. First, I introduce a state-switching predictive regression model in which the market state is defined in real time using the slope of the yield curve, the difference between the 10-year Treasury yield and the 3-month Treasury bill rate. This real-time indicator allows us to detect shifts in economic sentiment before they are confirmed by official recession dates. Compared to the standard one-state predictive regression, this state-switching framework significantly improves both in-sample and out-of-sample forecasting performance across a wide range of popular predictors, as identified by Welch and Goyle. The gains are not just statistical, they're economically meaningful, with most predictors delivering stronger and more consistent returns during both boom and bust periods. Second, I propose a new aggregate predictor, the Aligned Economic Index. Constructed using partial least squares, a method that explicitly maximizes covariance with future excess returns. This index synthesizes information from 16 widely used macroeconomic and valuation variables. Unlike traditional approaches such as principal component analysis, which focus on explaining variance in the predictors themselves, partial least squares targets the actual forecasting objective, predicting the equity risk premium. Under the state-switching model, the Aligned Economic Index delivers statistically and economically significant predictive power, both in sample and out of sample, and consistently outperforms benchmark predictors like the dividend price ratio, book-to-market, and even other combination methods. To understand why this matters, consider the challenge of predicting stock returns. For decades, researchers have tested whether valuation ratios, interest rates, inflation, or credit spreads can forecast equity premiums. But a recurring problem has been that many models fail to deliver reliable out-of-sample gains. Two major issues stand out: model uncertainty. No one knows the true specification ex ante, and parameter instability, where estimated relationships break down over time. One explanation for this failure lies in the fact that investors don't use the same information or forecasting rules in every phase of the business cycle. During expansions, they may focus on growth prospects and earnings momentum. When the economy weakens, attention shifts to risk, liquidity, and yield curve dynamics. This changing behavior creates time-varying predictability. Predictors that work well in one state may fail in another. This insight motivates my approach, a predictive regression where the coefficients are allowed to switch between states. Specifically, I define a down state, when the yield curve has been flat or inverted at any point in the preceding 9 months. This threshold is short enough to avoid locking the economy into long-term downturns, yet long enough to reflect meaningful shifts in macroeconomic sentiment. The choice of 9 months is not optimized. It's fixed to prevent data snooping and overfitting, a key concern highlighted by Welch and Goyle. The resulting model is RT plus 1 equals beta 0 plus delta 0 ST, plus beta 1 ST XT plus gamma 1 1 minus ST, XT plus epsilon T plus 1. Here ST is the state indicator, 1 if the yield curve was inverted or flat in the past 9 months, 0 otherwise. The key innovation is that the slope coefficient on the predictor XT is allowed to differ depending on whether we're in an expansion, ST equals 0, or a down state, ST equals 1. When beta 1 equals gamma 1, the model collapses to the standard one-state regression. But when they diverge, it captures the idea that different rules apply in different regimes. Out-of-sample forecasts are generated recursively. Using only information available up to time t, we estimate the model parameters and project forward. This avoids look-ahead bias and ensures that our results reflect what an investor could have known at the time. Now, why use partial least squares instead of principal components? Because PCA maximizes the variance explained by the predictors, often picking up noise that's irrelevant for forecasting. In contrast, PLS maximizes the covariance between the predictors and the future excess return. This targeted dimension reduction is especially powerful when many predictors are noisy or contain idiosyncratic variation. The Aligned Economic Index, built through this process, tracks the underlying economic forces that drive equity risk premiums. Figure 1 shows its evolution from 1960 to 2017, alongside the normalized equity premium. The two series move closely together, especially during major stress episodes: the 1987 crash, the dot-com bust, and the 2007-2009 financial crisis. Importantly, the index is less persistent than traditional valuation ratios, meaning it's less prone to small sample biases that plague long-horizon regressions. Empirical results confirm its strength. Table 1 shows that in a standard one-state model, the Aligned Economic Index achieves an in-sample adjusted R2 of 4.65%, far outpacing the PCA-based factor, 0.61%, and the forecast combination method, minus 0.08%. More strikingly, its out-of-sample R2 reaches 2.60%, well above the 0.5% threshold proposed by Campbell and Thompson as economically meaningful. But the real improvement comes in the state-switching model. Here all three combination methods, EPLS, EPCA, and EFC, show significant gains. The aligned economic index now delivers an in-sample R2 of 5.9% and an out-of-sample R2 of 4.12%, both highly significant and well above the benchmark. What happens when we break it down by state? Table 2 reveals the full picture. In the one-state model, the aligned economic index performs well during recessions, R2OOS equals 5.99%, but only modestly during expansions, 1.45%. The PCA-based factor fails to predict returns during expansions, and even underperforms the historical mean during recessions. But under the state-switching model, the story changes dramatically. The aligned economic index now forecasts the equity premium with strong, consistent performance across all states. 1.71% R during expansions, 11.21% during recessions, 4.51% during up states when the yield curve is steepening, 1.68% during down states when the curve is inverted or flat. All exceed the 0.5% threshold. More importantly, it works at the turning points, right when the yield curve inverts, signaling an imminent downturn. This is a critical improvement. In the one-state model, the index often fails just before recessions begin. But in the state-switching model, the shift in coefficients allows it to adjust precisely at the moment of regime change. The forecast combination method, EFC, behaves similarly, though with smoother forecasts. The correlation between EPLS and EFC is about 65% over the out-of-sample period, rising in down states. This suggests both methods capture a shared component of risk premium variation, especially when market stress is high. Why does EPLS outperform? Because it dynamically weights its predictors based on their predictive relevance. Figure 3 shows that it assigns higher weights to variables like equity premium volatility, the treasury bill rate, and long-term yields, especially around regime transitions. These are precisely the variables that matter most when economic conditions shift. In contrast, EFC uses equal weights across all predictors, which smooths the forecast but reduces responsiveness. In conclusion, this paper presents a robust, practical framework for forecasting stock returns. By combining real-time regime detection, using the yield curve slope, with a targeted predictive dimension reduction method, we build a model that works not just in recessions, but across the full business cycle. The aligned economic index isn't just a better predictor, it's a more aligned predictor, one that evolves with the investor's shifting attention and the changing structure of risk. For investors, this means more consistent, reliable forecasts. For researchers, it offers a new path forward in the quest for robust return predictability, one that respects the dynamic nature of financial markets. And the message is clear. If you want to predict the stock market, don't assume the rules stay the same. The best models don't just react to data, they anticipate the state of the economy.